Analysts for the month series. We have people from Alteria Capital, the managing partner Ankit and Sweta. As you all know, the rest of the month is where you get to catch up with investors, have a chat, clarify all your doubts, and also kind of have a frank, candid conversation with investors which you've never been there. Most of the time when you send a pitch deck to them, they don't even bother reading it, so it's in their reputation as well. So this is one way to kind of catch them in flesh and blood. Jokes apart, I think a lot of people today are kind of becoming aware of debt fund and at an early stage itself as to how you need to start practically thinking of fundraising as you grow. And some of these basics of debt fund is what can I request you all to please put your mobiles on? Okay, so coming back, I think today a lot of startups right at the beginning are thinking of debt fund going forward. And given the business environment today and what is coming ahead, I think debt funding is going to become very, very critical to your funding metrics and mix going forward. So far, I think in India rode on the pure equity kind of a ride, but I think it's going to be interesting going forward. And to take you through some of that, we have Ankit. Ankit has been the managing partner. He's one of the four who kind of is originally part of the Silicon Valley bank team, which then got acquired by So they've seen through the whole debt fund cycle. So in effect, actually, they were one of the true first debt funds in India, if I'm not mistaken. And from there, he's been a banker. From there, they kind of once it got over, they kind of started Alteria, and they raised 980 crores in their fund 1, 1,000 crores, 1,800 crores in fund 2. Right now they are on target for 3,000 crores, of which 1,000 crores is closed, and their deployment is also finished in both the funds, and now they're concentrating on fund 3. A lot of the D2C brands that you see today are their clients. Please visit their website, and I think we also sent you all an email or just their profile of clients, kind of show you who they're funded. Take a look at that. And the format is going to be that Ankit and Sweta are going to talk, give them about 20-25 minutes to talk and take you through the basics. And then, of course, this is like always in time, it's going to be an open forum. Feel free to raise your hands, talk, and again, understand one thing, whatever is spoken here remains in this room. The Chatham House rules apply, so feel free to talk if you've got any experiences that you want to share. But again, take a few things that you can learn from here and go back. So that's the key. Again, happy to always have Sweta. For people who don't know Sweta, she was a part of the Mumbai team about 10-12 years ago. So she's our prodigy and baby. She's the one who actually started the accelerator programs way back then for TIE. She was part of the TIE IQ bootcamp. So always happy and a pleasure to have her back. So over to both of you. It's your thanks.
Thank you so much, Anil. Hi guys. So both me, Ankit, and Sweta, my colleague, we are team members at Alteria Capital, and Anil, thank you so much for the kind introduction. Actually, before we start, the way we would like to engage is, one is we make it very engaging. Second is we would love to know our audience on who we are talking to. So Naveen, if you don't mind, we can just spend 5 minutes where we can just quickly go around and you guys can introduce, tell your name, and in few lines tell us what you guys are doing and maybe what you're here for. I think that will probably make it more engaging. If you want to just ask something.
Yeah, pretty cool, yeah. So I'm Saurabh. Been a banker for more than 2 decades, and right now run our own fintech. There is a credit decisioning platform. So we triangulate 3 kinds of data: bank statement, GST, and financial statements. As in crunch huge amount of data in the within a minute or so.
Thank you. Because it's fine. No, it's no problem. Yeah, it's switched off. No problem.
So what is my expectation? I mean, venture debt I know. I mean, because we used to fund a lot of venture debt companies also. I just want to understand what is the present environment, whether funding winter also exists for venture debt or not, and how it functions. Is it in a source of funding?
Hi, I'm Rajas. I'm from Capsavvy. I'm an investment analyst. What I do is I usually review pitch decks and financial models. I value companies' valuation, and then I maybe suggest to the community, investment community, that they should invest or not. That's my role here. And with Alteria, I would like to get to know how does this all function. As he rightly said, how does this all function? Because we know everything about venture debt, but the internal things maybe.
Sure.
Thanks.
Hi, this is Abhishek, founder of Health Innovate. We are into D2C lifestyle, beauty, wellness and fitness segment of products. Currently our presence is offline, and also we have developed our website. Through that we are generating leads online also. So currently our stage is seed stage. We have bootstrap, self-funded. So we are looking for fund. So my question is again, how we can utilize mutually beneficial.
What's the product?
Our products is in premium category like glutathione, collagen, that kind of product segments we are into. So, thank you.
Hi, my name is Nikesh. I run a collateral agency called X Pitch Deck. So we create pitch decks, we plan go-to-market for startups. From a debt venture point of view, there are a few startups which are also trying for a debt, but unfortunately, nothing worked out on a debt side. So probably want to understand how does this thing works and what kind of proposals will suit for that.
Sure.
Hi, over here I have a B2C brand called Agarwal. We are present on Myntra, Nykaa, Ajio, and we have another brand called Persano for jewelry, imitation jewelry, fashion jewelry. Just looking out for some networking.
Sure.
I am Rajesh Vyas, on the third startup, lucky to have exited one. We are an income tech company which takes care of integration of career plus finance together. And I am here to understand what venture debt is all about. I am absolutely no clue.
Hi everyone, my name is Harpal Parmar. I'm a co-founder at AUI Systems. We are a B2B deep tech. We provide cognitive automation product to energy companies, and we're a bootstrap company until now. Looking to understand more about venture debt and network at this event. Thank you.
Hi everyone, this is Hardik representing Qualified Care. We are into the medical equipment rental solution. We are an asset and trying to create a tech-based model through our online e-commerce rental platform for patient care. We have already raised the seed round almost 1.5 years back, and currently in a journey to raise next round. Like normal standard practice, we always go for equity. So this is the venture debt we would like to explore and understand more. And TIE is always a good platform to have networking. Thank you so much.
Hi everyone, Chiju Lamani here. I'm the co-founder of Dial 4242 Ambulance Services. It's an aggregator into ambulance services, in simple Uber for ambulances. I started this service as my dad got a heart attack and he could not get ambulance in time. So that was the breaking point. Today we are doing quite well, present in almost 500 cities. We have raised angel funds. We have been profitable last year as a company. Okay, looking to expand. Our primary audience is B2B audience right now. Okay, so we are making revenues, we are profitable. So now the idea is to expand. That's what we are looking out for. Thanks.
Hey, hello everyone. I'm Nishita Agarwal, co-founder of Papa Possum. We are a national pet care company, a B2C brand making so to say, we are mama earth for pets. So yeah, we started around 1.5 years back. We listed on all the e-commerce and portals, selling through our website, helping other pet parents in their journey of this distinguished pet parenting, which is coming up very rapidly now. We raised a seed round, and we are almost set to start our new round for our expansion and growth. We've been doing quite decent over the past 1.5 years, and we look to expand more.
Okay, it's a very interesting space.
Sorry?
It's a very interesting space. We are part of the company.
Yeah.
I'm Ashwani Nanda. We are working for one of the marketplace called EasyServe, where people can buy any service. Like Amazon, people can buy any product. Like Zomato, people can buy the food. In our case, EasyServe, people can buy any service. So any service, anytime, any place. We are bootstrapped, and we are looking for a mentor or with an advisor for our future journey. Thank you.
Hi everyone, my name is Saloni, and I'm running two brands, one which deals in fashion jewelry and hair accessories for kids, and the other one is we manufacture men's apparel. Both of these brands are predominantly based in the e-commerce sector. We have been running for the last 9 years now. We started in 2014, one of the earliest brands on Amazon, and we are looking to expand further now.
Hi everyone, I am Piyush Kothari. I am the managing partner of Waterfront Capital. We are a wealth management company, and we work with few of the venture debt companies where we help our clients invest. So exploring opportunities with Alteria. Waterfront Capital. Sorry for my voice, I have a sore throat.
It's because there's another wealth management Waterfield.
Waterfield, correct. We are Waterfront. That's right. Correct.
Also Wealthfront.
Sorry.
There's also Wealthfront.
Oh, is it? Okay, I'm not aware. Thanks.
Good evening everyone. My name is Dinesh. I come from Mumbai. I run a conventional marketing company. We help our clients with their promotional campaigns, promotional products, plus we also help them with their corporate events.
Hello everyone, my name is Manish Advani, and I'm the founder of a company named Nemo Potential. Since the time I had the privilege of working with the Indian Space Research Organization, I've picked up one thing, which is culture from ISRO, and I'm driving cultural change through mindfulness amongst the corporates. And the company is doing pretty well. I mean, we had a very fabulous start. We signed up clients like T-Hub, Morgan Stanley, SBI General, BNY Mellon, a couple of other clients. Thank you.
Hello, my name is Vishal Sanghvi. I am promoter of my company, Engaged with the Cloud Telephony, which I started during my academic time in year 1989. And I am a TIE member since 2008. And what I learned from a time to disrupt your own, and how you can think for the future. So then, in 2010, I have the 2 million transaction every day for the carrying connections. And now jumping to the IoT area, developing smart cameras for the different things, and developing the protocols which is set to the Indian area. So we are launching the battery-enabled lithium camera, solar camera. So now surveillance product portfolio expand to the defense and many areas. So we're looking for the fundraising for global demand for local manufacturing, and there is people looking for more and more applications for the smart life.
Thank you guys. It's a pretty diverse set of question about venture debt, and then I'll pass it on to Sweta where she'll talk about what she is doing within Activate, and then we'll open up for questions here. Like before starting about talking more about venture debt, right, I would actually take a step back and give my view and perspective about venture capital itself. Like, let's understand what is venture capital and who should raise funds, why should even someone raise funds, right? The whole startup ecosystem, venture capital valuation, we started hearing that like 5 years, 10 years back. Is this so that companies were not getting started and built all these few hundred years back, right? The companies like Tata's and Reliance, right? They were all startups, right? But they never raised any venture capital, venture debt, right? Why is it so, right? So let's try to divide the kind of businesses into two aspects, right? One is, for a lack of better word, conventional businesses, the way they've been built, right? And one is new age business, right? For building any business, you need the following things, right? You of course need an idea. you need entrepreneur to take that risk, you need people, you need market, and you need capital, right? If you look at conventionally how businesses have been built, right? It could be a second generation founder or a promoter whose dad was probably running a manufacturing entity for 15 years, and son decides to kind of run another unit with a different category, different product, where the factory was already in place, the capital was in place, bankers were in place. There was somebody to kind of take that risk and give that backing, and you can choose, and the business have been running profitably. And as a son, you decided to kind of venture out and do some interesting things in manufacturing, where you get all the support and you decide to grow, 20-30% year on year and become profitable, right? Where you are incrementally trying to do different than what your father did or what everybody else was doing in the market. There was an incremental change that you're bringing to the society, right? And you have your own path of 10, 20 years that you signed up for that. That is conventional way of doing a business, right? What is the new age of doing business? New age of business, it's not a second generation, third generation promoter. It's a 25 or a 30 or a 60-year-old founder who was probably doing something completely different or was in the same business, had an idea which did not have an incremental change. The idea was disruptive enough to make a massive outcome in a very short span of time. All these are very important things, right? When we talk about new age business, it's very important that idea is very disruptive, it is very scalable, and it is scalable in a very short span of time, which can potentially have a very large outcome. But all of that obviously comes with risk, right? Because there is a big plan that comes together, because there is a great founder, great idea, potentially great product, great market, right? A founder cannot put in all that capital to essentially start the business, right? Well, you can put that capital, you can probably put a few crores, right? But if you're putting all your capital, you don't want to go that crazy in terms of expansion, because you want to run the business in a very profitable way. That you then choose to build business in a certain way where you probably become profitable in 6 months, and you choose to grow 20-30% year on year and have a little bit of more conventional way of doing that business. But why does venture capital come into place, right? Because if the idea is so disruptive, and the idea could be disruptive because the technology being used, the product itself is very differentiated, or the way you have looked at the market is very different, or the business model itself is very different, that based on that idea, the thesis is this business can essentially become really big, but for that business to become big in a short span of time, that requires capital. And founder himself or herself don't have that kind of capital. Hence you go out and raise institutional or professional capital. This is the new age that is important, right? This new age of capital funding started in the US in the 1970s, where when the Apples and the Microsofts of the world started, where there was a tech startup started in the garage, where the idea was so disruptive that people started believing in that idea that hey, if I have 100 rupees of capital, my business is not growing enough for me to put 100 rupees in my own business. Can I put that 90 rupees into somebody else's idea, where I want to grow that capital faster? That's where venture capital comes, right? It's very important to understand what is the genesis of venture capital. Venture capital is a pool of very high risk capital, where people, it could be a provident fund, it could be a hedge fund, it could be a very large family office, where people are saying that hey, I want to allocate 10% of my capital to very high risk capital, where possibly I can make 100-200% returns. That pool of capital essentially goes into the pool of selected founders, where the idea is good, product is good, founders are good, blah blah blah. Right? Now what is happening in the new age is that capital becomes a very important determinant of your success. And capital is both an input and an output. Capital is an input for you to grow the company. Capital is also an output because all the things you have done, you get capital. Right? This is what venture capital is all about. That sometimes people also always ask this question that this company was making losses of 10 crores a month for last 2 years. They got some 100 crores of capital. I am a company which has 1 crore of profit, but nobody is giving me any capital. Okay? We have to understand that venture capital, for very nature of it, is a capital which is signed up for taking higher risk in return for very high return. If your business is not that scalable, that potentially you may not get a 20x, 30x return, venture capital is not interested. Venture capital is okay to take the risk of losing all the capital, but it's important that the outcome and scale is very high. So one of the things that I always tell founders is it's not always important to raise venture capital. You can always run a very, very successful business without raising venture capital. It's the path that you decide to choose. If you are running a, let's say, ambulance startup, right, and you're running that for last 5 years very profitably, it's a path you may choose to not raise venture capital, grow sequentially, own 100% of a company. But if you choose to sign up to a path where today you're not satisfied by 10 crores of revenues a year, you want that 10 crores of revenue to be 500 crores of revenues a year, and you want to take that business to not only different cities in India, but different cities worldwide. In that case, you go, it's the idea that it's very scalable. It's scalable because you can probably use tech and your expertise. You raise venture capital, but that also comes with the idea that you have to run very fast. And if you run very fast, the potential outcome could be huge. But there is a pitfall, and if you don't run very fast, you may fall asleep, right? So that's a path you choose, and one of the other questions that I typically get, and then I'll move to venture it. One of the answers that I typically get is, how do I know whether my startup should raise venture capital or not, right? While everybody may have their own answer, I believe that you should raise venture capital only if you think that your idea and your business is not marginally different. If it is substantially different and you think you have certain modes where you can massively scale the business, not just revenues, but eventually there should be large profit pools where you can return the capital 5 to 10 times over. If you think you can do that over 5 to 10 years, you may fail in doing that, but you should believe in doing that. Is there a part to it? Because a lot of times this is reject you feel that your idea to अच्छा था मैं profitable भी हूँ, I'm doing this business for last 10 years, but a random 22-year-old founder comes and based on a deck, they end up raising $1 million. This is the reason that venture capital is looking for an outsized outcome. They're happy to take a lot of risk, right? Now let's come to define what capital is, right? And let's understand the journey of a company, right? Typically, if you look at most of the large companies, right, which may or may not be startups, right, they don't keep raising capital. The only capital they raise is debt capital from banks. Today in India, if you look at the kind of capital being infused for growing businesses, 95% of that capital is debt capital. It's all coming from banks. While we all keep hearing stories about private equity, venture capital, all of that, right? Nobody talks about the boring capital which is coming from banks at the cheapest rate possible, right? But understand there is a big difference between debt and equity, right? And equity capital is a very high risk capital and is forward looking. And I'm happy to potentially lose my capital, but I want a 10x return, right? Return expectation from venture capital is approximately 40% annually, IRR return. The return expectation for a bank on the one other extreme end is 8 to 10%. Then naturally they don't want to take that risk. Hence they are backward looking. That what has company done in the last 3 to 4 years, based on that is the company profitable, they don't have enough collateral, and bank is looking for more downside protection. That I don't care about whether you go 5x or 10x, I'm even not getting an upside. I just want my capital back along with my return. So on one extreme there is venture capital, on the other extreme the cheapest capital is bank debt. Within capital, venture capital also, equity capital, there's venture capital, there's private equity capital. Private equity investors enter at late stage because they don't want to take a lot of risk. Hence their return expectation is 20% IRR. A venture capital return expectation is 30% IRR. For an angel investor, the return expectation could be 50% IRR. Because for an angel investor, out of 10 bets, maybe 1 or 2 will work, 8 will not work. For what that 1 or 2 to work, they expect a 15x outcome under 1 or 2 to work. Otherwise, angel investing will not make sense, right? The reason I'm telling you that is when we think about capital, right? As a founder, you should understand how is investor thinking about capital. How are we thinking about capital? And the two most important terms that is associated with any form of capital is risk and return. Always important, right? If you put your own capital, there is a certain amount of risk and return that you always keep thinking. Whether to put in an FD, whether to put in mutual fund, whether to put in your business. Same way we also think it, right? A venture capital is thinking about very high risk, very high return. Private equity is thinking about slightly low risk, slightly low return. Bank is thinking very low risk, very low return. Now where does venture debt come into the play, right? In the journey of a startup, that now let's come to new age. Venture debt only deals with new age startups. Because for conventional startups, A conventional startup naturally, hopefully, will be profitable. If you're profitable, you will get bank funding. Then why would you even think about taking a high risk, high cost debt, right? Now, if you look at the cycle of any startup, and now we're talking about only new age startup, which is in the business of creating large outcomes, hence capital is important to raise, right? That you typically go and start raising money with, you put your own money and raise friends and family money, right? So maybe I'll give an example that you start with a business idea of putting 50 lakhs together with friends and family and just kind of take off, put a website together, put a small team together, right? You put a brand together. Once there is a little bit of idea kind of getting, there's a little bit of shape of the idea, you start going to different networks, angel networks, time networks to start raising angel money, right? These angel investors essentially are betting on two things, on the idea and most importantly, they're betting on you, right? When you are very seasoned, if your profile is really good, they're essentially betting on you that you must have thought enough about it, that I just need to look at the founder. Ultimately, you execute kar right? Now, uska product market fit hoga, kini technology hai, kini market kitna bada hai, the founder is smart enough to figure it out, right? Ultimately, people are betting on the founder. This is still very, very stage. For example, you started at 50 lakhs, now let's say if you raised 2 crores of angel capital, right? All angels, where they invest in any startup, they sign up to the fact that they will lose their entire money, and they are okay with it, right? As in, I have myself done 20 plus angel investments. In each and every investment, I do it knowing that I will lose the entire capital. But I think and hope that at least 5 of that works, which can give me 50x return or whatever, right? Again, the reason I'm restating these things is all of you guys understand how risk and return works in capital, right? You raise angel money of 2 crores, right? Then you think now you have a product, you have a customer base, you have a website running. Then you think that you probably have 10, 20 lakhs of revenues going, right? So something is really working out. But for it to work out, you need to scale fast. For you to scale fast, you need to hire people, you need to build technology, you need to do marketing. But guess what is required for that capital, right? Now, with every time you are raising capital, technically the risk in the company is slightly reducing. The most risky capital was your own capital, where you were the only believer, right? Followed by angel investor, right? Then followed by, now that you have 10 lakhs of revenues, you go out and start talking to seed funds or pre-series funds. Okay, can I now have 10 lakhs of revenues a month? I have almost 1.5 crores of revenues a year, right? And let's say I'm dealing with apparels, right? Or let's say into a pet care startup. Let's talk about a pet care startup journey, right? That you put your own money, you raise from angels, and now you go and raise from a seed fund. And that seed fund essentially is taking slightly lesser risk than angels because now you know that company has 10 lakhs of revenues, and seed fund decides to put 5 crores in the company, right? This 5 crores in the company is to fund you for technology, for marketing, for hiring. That can you take this 5 crores and get your revenues from 10 lakhs to 50 lakhs a month, which is 5 crores annually, right? Which may or may not work, but that's the bet that they're taking, right? Which is higher than an angel investor. In terms of risk, it's lower, right? Even at this stage, the companies are all still very highly risky because companies have not done enough of this, and typically all of this happens in a matter of a year, 2 years. If you look at conventional companies, they typically take 5 years, 6 years. The more time you take to build a business, the risk typically reduces in a business because businesses are self-sustainable but may not be scalable. But if you've chosen the second path of new age companies, you need to run fast, right? Now, this company now has reached seed money of 5 crores, right? What is the next step? Now you have reached a revenue of 40 lakhs, 50 lakhs, but because you're not focusing on profitability, you're focusing on growth, you may be still burning cash because your focus is to grow, get more customers, right? Now you're at a stage where 5 crore, you have left with 1 crore, right? But your business is seem to working very well. Ki mera jo, what we call as GMN product market fit seems to be working out. मेरी जो thesis थी broadly is working out. Can I now take this 50 lakhs to 5 crores of revenues a month? Then you go to a venture capital investor in the likes of Sequoia, Axel, Nexus, all the top VC fund names that you keep reading on the pink paper in the morning. That's where you go and tell them that look, I put my own money, I took angel money, I took seed money, I have grown from 0 to 50 lakhs, right? Now for me to get to 50 lakhs to 5 crores, I need to build a better app, better tech, I need to get better people, I need to do more marketing. I have a plan where if I get 25 crores of capital, over the next 18 months I can get 3 to 4 crores of revenues. Right? And somebody decides that somebody puts that money into it. Right? And what is the right valuation for that is determined by the market. There is no rocket science, there is no Excel formula that determines an valuation. You get 5 investors, they bid for it. Whoever bids highest, you take that money based on value and relationship. Right? Now, every stage of fundraising, now you have done 3 fundraisers. Right? You've raised money from friends and family, you've raised money from seed investors, you raised money from venture capital. And the ownership in your own company is probably reduced to 70%. Because when you raise money from friends and family, you put some nominal amount of, you raised let's say 50 lakhs, but you have to put some valuation in the company. Let's say that was 4 crores. You diluted 10%. Then you raise money from seed investors, you diluted another 10%, 15%. You raise money from venture capital investors, you diluted another 15%. And if there are 3 co-founders in the company, you have 20% owner each in the company in the first 2 years of your company. And you have another 15 years left. And you have another 5 rounds of capital raising left before you go for potentially an IPO or company becoming profitable. By that time, you think that I have ownership to probably become 2% of my own company. Because I need to keep raising capital because I have chosen this path of growing fast, becoming scalable, and chosen the path of raising capital and grow faster rather than the conventional part of owning 100% of my company, being profitable and run it for 30 years. Right? Now if somebody comes and tells you that, hey, instead of raising venture capital money of 25 crores at 100 crore valuation, where you are diluting 25% ownership, if ICICI Bank comes and tells you that, hey, instead of taking 25 crores from Sequoia Capital, take this 25 crores from us and just pay me 10% interest rate an annum. And you are retaining 25% of your ownership. आपको तो capital चाहिए था, आपको मिल गया. Would you take that option? Raise your hand if you would take that option.
Yes.
Raise your hand if you will not take that option.
It depends.
What will it depend on?
I mean, how much is the cash flow that you are generating? Positive cash flow. I think we pay, right? 28 crores I have to be paid. ICICI is not going to see a bullet repayment.
So let's say ICICI Bank decides to give you bullet repayment.
Then
you'll take that option. Right? ICICI Bank decides to do a bullet repayment, give me after 4 years. Right now, I'm fine you doing burning your business, but after 2-3 years you could be profitable. जब आप profitable हो जाओगे तो मेरा पैसा return कर देना. But right now I just need 10% interest on my capital, and you don't need to dilute any of your ownership.
10% is still 2.5 crore, but I will want to put it back in my business and then grow it.
Sorry, say it again.
10% is still 2.5 crore of 25 crores. I would rather want to put that 2.5 crore in the business and grow it faster to 150.
But the option you have in your, the 2 options on the table is, one option where you raise venture capital and you are 60% owner in your business. Second option is you have raised from a bank and you are 80% owner in your business.
60%, but if I am only a 100 crore brand with a 80%
but you are still getting the same capital to get to 50 lakhs to 5 crores. Instead of raising series A, you directly raise a series B. See, eventually, what I am trying to get, you are not running this business to raise capital.
Yeah.
You are running this business to create a large outcome, create massive revenues, massive pools of capital. That end of the day you make a lot of money. How do you make a lot of money? Either somebody buys you out or you go for an IPO. You don't make money by raising venture capital guys. Let's make it very clear. When we keep hearing on the big paper that a founder has raised $100 million, right? I can tell you that the salary of the founder could be 20 lakhs annually. And the founder may be traveling by train. These are real stories. When founders are raising $100 million, they probably own 20% ownership of the company. Only if there's an eventual exit, then founders make money. All of every series A, series B, series C is going to the company, not going to the founders. Right? The point I'm trying to make is, at some point of the journey, right, founders start realizing that every time I'm raising capital from my business, it's great for business is getting capital. I have more money than my competition, I can grow faster. But every time you raise money, you are diluting a part of your ownership, right? And it pinches the most when you actually cash it out. Is your outcome a 100 crore outcome or a 1,000 crore outcome? Right? Today, if a founder owns 40% ownership in a unicorn or a 5% ownership in a unicorn, completely changes the game. Not just money, but your influence on your own company. There are cases where founders may be left with 15% ownership in the company and the CEO is changed to a professional CEO. Because guess what, more than 50% ownership is with a venture capital investor. And they don't feel founder doing enough. And they're doing what is right for them. Because they actually own more of the company than you yourself, who started with an idea. Right? This is where the concept of venture debt was really born in the US actually in 1970s. That hey, the option of ICICI Bank is not available. This was just an example I gave to you to make a point that, of course, if you have capital without dilution, you will raise it. Because your eventual aim is to own your company and make your company successful. These are the only two outcomes, right? Make company successful and make a lot of money. Let's be honest, right? But because an ICICI Bank option is not available, why is it not available? Because the way bank thinks about debt capital is very passive. You have to have vintage profitability because bank is saying that I am worried about my money getting lost in a startup. क्या आप loss making का मैं को कैसे करोगे पैसा? As Sir said that how will the bank even get the money back if you are loss making, right? So venture debt was born with the understanding of first how does this ecosystem really work, right? That for you to evaluate startup, you cannot look at conventional things like profitability, vintage, collateral, asset. Right? You have to look at future of the company and still do a debt transaction. The way equity guys look at a deal, as a lender, you have to start looking at a company that hey, will this company survive for next 3 to 4 years? For as a lender, if I think that this company will definitely survive for 3 to 4 years, and I am so bullish that I am sure this company will keep raising capital, I shouldn't technically mind doing a debt to a company at 14%, 15% interest rate. Because I know that this company will continue to raise capital. Right? That's why venture debt was born in the Valley in 1970s with the thought that a lot of these tech startups are great in enterprise value. They are building something very special. It's just that they are choosing not to be profitable because the focus is growth. Right? Why should I not be able to lend to these companies? They may not have a personal guarantee or a house to lend to or to mortgage to. But I believe in the company that this company will always be valuable enough to get my money back. Ultimately, as a lender, what is most important? I should get my money back in a matter of 1 to 2 to 3 years with my interest, right? For equity, the horizon is 7 to 10 years with an eventual outcome. For a lender, I should just get the money back, right? So what we are doing in venture debt, right, is we are coming at a stage where we think that the mortality risk of the company has drastically reduced, right? That is why we choose to come into companies when companies have raised or raising a series A capital. Which means that you have put your own capital, you have raised from friends and family, you have raised from angels, raised from seed investors. And the natural understanding is, अगर आप series A पहुंच गए हो, right? Naturally there is a product market fit and you have an equity base of 20-25 crores. And our proposition to founders is, instead of raising 30 crores of equity capital, why don't you raise 20 crores of equity and 10 crores of debt? So we are actually co-investors where we bring in low cost of capital. And why do I say low cost? Because the cost of equity is 30%, cost of debt is, for us, it's not 15-80%. I am more expensive than banks because I'm taking more risk than them. I am much cheaper than equity, right? So we never try to replace equity. What we tell to founders is when you are raising capital, right, you should raise with a mix of equity and debt. When you needed 20 crores, up to 20 crores will give, but your dilution is restricted to the amount of equity that you have raised, right? So a typical example to demonstrate how a venture debt deal works is, if I continue with this example, let's say if you go and raise a series A capital, and if you raise, let's say, I'll give an example of a company that we funded called Supertails, right? That company, when they were raising the series A round of around 30 crores, right? We told them that, hey, why are we raising 30 crores of equity capital? Why don't we raise 25 crores of equity and 5 crores of debt? You are still getting 30 crores of capital, but you will save 3 to 4% dilution in your company if you replace that equity, extra equity with debt. Should they have done entire debt of 30 crores now? There is a proportion of equity and debt that we typically do, which typically a thumb rule is 80-20. That if you are raising 100 crores of capital, raise 70, 80 of equity, raise 10 and 20 of debt. How do I get my capital back? Like you're not a profitable company, right? So our structures are typically a 2 to 3 year term debt, where our point is, my capital mostly will come back if you are able to raise a next round. Right? So for example, if I am coming along with Series A, I am giving a 2 to 3 year loan, some part of my money comes back with the existing cash, a large part of my money comes back when you raise your next round.
Nothing from the revenue.
The revenue is not important because you're not profitable only, right?
No, but then...
So with the existing cash, so I'll give you an example. Let's say, for example, you raise 25 crores of equity, 5 crores of debt, right? And you're burning, let's say, 2 crores a month, right? With only equity of 25 crores, you had a runway of, let's say, around 10, 11 months. With some more debt, you have another 2 to 3 months of runway. With additional 2 to 3 months of runway, instead of going to 4 crores of revenues after 18 months, can you get to 5 crores of revenues after 18 months? With additional runway, you can perform better. If you perform better, your next round valuation could be higher. Now you get your next round, now you can return the capital back. Now again with the next round, you take another venture debt from me. So we are also very stage agnostic. So every time you raise capital, you raise a mix of equity and debt. So across most of our portfolio companies, we start with Series A, but every round we do Series A, B, C, D and beyond. And what happens is the proportion of equity debt changes. In a Series C, founder could raise 40 of debt and 60 of equity. Because we want to save more and more of a dilution. As a lender, I feel more and more comfortable because company's mortality risk has reduced. Come from Series C to Series A, it naturally has reduced, right? There could be a time where you become almost profitable, but banks are still not funding you. And then you equity raising but career debt for a later. And directly go for an IPO. All those things have also happened. So net, what not to formally introduce our journey, as Naveen was saying that we started we pioneered the venture business in India in 2008, where we got Silicon Valley Bank, which was a pioneer of venture asset class in the world. They started doing venture in the Valley in 1970s. We got them to India in 2008 as the first venture business in India. Those days Flipkart was still selling books. We remember having called with Flipkart, they were trying to move from books to panels to selling mobile phones, and Myntra was, I think, still doing customized t-shirts then. And it's been a long journey for us. From 2008 till 2014, we ran Silicon Valley Bank's India business. 2014, SVB's India venture business was sold to Temasek, and the name changed to Innovate Capital. 2017 is our team ventured out, and we started our own fund, a homegrown fund with the name of Alteria Capital. And as a senior leadership at Alteria, we've been doing this for over a decade now. We funded more than 500 startups in India, deployed close to $1 billion, 6,000-7,000 crores of capital across startups, which includes 20-30 unicorns. There's a chance if you name a big startup, we may have funded it. We've just been very fortunate to be around for a very long time. It includes names like a Swiggy or a Byju's or a Myntra, First Cry. I mean, most of the larger startups we were able to come at some point of time and help them with debt capital. Before you ask one question, one thing I will just address it already is that there is a reason why we don't do pre-series A, is we feel that companies don't have enough product market fit and don't have enough equity capital base to start servicing debt capital. Because debt comes with certain servicing of interest and principal. Till you have certain scale and certain equity base of capital, it's very risky for you to even take that level of liability. Kind of transitioning to Sweta on what our team at Activate does is because we are in an ecosystem where who all are stakeholders around us. We are dealing with founders, we are dealing with a lot of VCs, we are dealing with corporates. Right? We find ourselves to be in a very interesting intersection where we deal with a lot of interesting stakeholders around us, where we believe that we can connect a lot of relevant dots. And hence, we start with this business called Alteria Activate, where maybe I'll request you to talk about what we are doing with, apart from providing capital, how we are helping startups with Alteria Activate.
Thank you, Ankit. First of all, I may freeze to death today. This is super cold zone. No.
Maybe we should move forward because the wind is there. You come here and find wind.
Yeah, this zone is so much better.
all, thank you so much, Naveen and the team here. It's home to me. I've spent from 2009 to 2014 time with time, and feels good to be coming back. Like Ankit said, the purpose of Activate, the vertical that we run into fund, is very simple. Because we work with so many stakeholders, what can we do apart from just providing capital to startups, right? Because if we are providing capital, we can only work with only those handful of companies. Like over the course of past several years, like Ankit mentioned, from 2008 to today, we've worked with only 500 companies. But with the vertical Activate, we have the opportunity to touch many more lives, to work with many more founders. So we work with non-portfolio companies, early stages, where we start helping them in terms of understanding who are the right stakeholders that you should be talking to in the industry. We help them get connected to early stage investors, where we have good relationship, where we think is the right time for them to talk to them. We connect them to late stage investors, why we think that this is the right time for them to start working with us. And it also helps build that relationship, right? If I'm talking to you, say for example to you right from your seed stage, the moment you come to that Series A, you'll be more comfortable taking capital from us, we'll be more comfortable giving capital to you, right? So it helps us build that relationship with non-portfolio companies across multiple different segments and stages. And also, like I said, help many more companies than only the companies where we can provide capital. The second thing that we do differently through the vertical than the other funds out there is we support our portfolio companies for amplifying their existing business growth. Now what do I mean by that? Like Ankit said, as a venture debt fund, my interest is how fast can my company get the next round and I get my exit in next couple of years, right? Or because, so one benefit that we have being a venture debt fund, we have the capability because of the size, but at the same time the regulation allows us to enter into a company multiple times. So if the company grows from Series A to B to C, it's in my interest, I can deploy more capital, I can work with the company for a much longer time, right? So we help our portfolio companies get connected to, again, potential customers or maybe smaller startups which are building some kind of products which will be relevant for these guys to help them get connected with those. So likewise we work with portfolio, non-portfolio. But the most important thing that we do at this vertical is run innovation programs. Now what do I mean by innovation programs? We run innovation programs in 3 different categories in fact. So we go to large corporates, understand what your innovation needs are. Now large corporates, their innovation needs could be, I have capital, I want to start investing in companies which have a strategic fit for me. Or I want to start looking at acquiring startups which may be relevant for me so that I don't have to build everything around up, right? Or the most important or the most common request that we generally get from corporates is I want to start looking at solutions which I can start onboarding as a vendor partner. So we run innovation programs for corporates for that. Currently we are running a couple of mandates. Then we work with government. Government again, state as well as central. The biggest challenge that today government nodal agencies, which are there state as well as central, they've come up with startup initiatives. They have money, they provide money. They have startups also who are coming up with problems, solving problems. But the biggest challenge that these guys are facing, those startups don't get access to investors. They don't get access to customers. What we do, we go to those government programs. We help them, help their startups get access to customers, which could be corporates or even our portfolio company. Because like Ankit mentioned, 30% of our portfolio company could be silicons or unicorns. Now these people have the capability of giving or providing business opportunities to these smaller startups, right? So we hope that those startups help them get access to their potential customers. We also help them get access to investors because these could be programs which are running in say tier 2 city or tier 3 city or even rural areas, right? Founders coming from those areas are creating beautiful products, solving amazing problems, but they don't have access to these things, right? So we help them get access to customers and to investors. We are currently running a program for DST, which is Department of Science and Technology. The program is called the Accelerator. So that's what we do at the vertical activate. Like I said, the whole idea is how can we work with multiple different stakeholders and leverage each other by the information that we have, and at the same time touch many more entrepreneurs or make a difference to many more of them.
Yeah, maybe we can open up for questions now. Sure.
What basis, like you stated that company should be at a growth stage, should be doing some revenue. What is the kind of benchmark which is there?
See, we have also done pre-revenue companies, by the way, right? I'm saying that to make a point that for us, there's no benchmark of revenues or growth or profitability for us to enter. Our most important benchmark is company to raise a Series A. The reason is, look, we understand most of the startups will prioritize on growth and not on profitability, right? For growth, you need a certain amount of capital based for you to be comfortable to take on liability of a debt. That, and since we can't do 10 lakhs, 20 lakhs of debt, right? For us, the minimum check size is at least 4 to 5 crores, right? For us, we need a minimum capital base of company should have raised at least 20 to 25 crores of equity, which typically is the Series A round. So our entry point for companies is typically Series A. Exceptionally, we have done companies where we have come pre-Series A as well. But still company should have raised at least 10-15 crores of capital, where, see, our model is also, since our model is a co-investment model, it's a partnership model for us. So we work very closely with venture capital investors to understand what they are bringing on the table, how are they viewing the company, and to understand their thesis as well. So for us, it's important that company should have had a venture capital investor, which has put in some amount of equity into the company, for us to see if that company can actually borrow while it could be still loss making.
Okay.
So I compare with the bank borrowing and you. So bank requires a lot of security. So you don't look for security or only potential about the companies and the future Series A funding potentials.
No, it's a very good question. Yes and no. We don't take any personal security, which means that if the business goes down, I will not come and take a loss or take a personal guarantee because I am underwriting along with you to take the risk in the company. But whatever company has, they charge to me. So I am a senior secured lender on paper, where all the IP and the security in the company is charged to me, which means that even if the company gets sold to 1 cent a dollar, the first money comes to me, then to your equity investors, and the last is the founder.
So there is every investor company has choice of service-based industry to choose, and one of the manufacturing based. If you talk about IoT, there is a combination of the software, hardware, cloud. So is there any portfolio of companies which we are more looking for? Because whatever relation you have it, first of all, we try our best to do the global alliances, which our vision is globally. So whether your choice of any criteria about portfolio company to choose first.
See, we are pretty sector agnostic that way. I can tell you if you just look at our website, you will be amazed at the kind of companies that we funded. It could be a jewelry company or a pet food company or a apparel company or a logistics company or a healthcare company. Wherever there is innovation, wherever there is incremental disruption in a business model which is not marginal, naturally will attract venture capital if the business model is very sound. Wherever that case is, venture it makes sense. So we are not averse to any business idea, any business model, but naturally it should be very scalable, very disruptive, and should have the need of institutional capital. That's why I keep saying that not every business will need to raise venture capital.
So,
So Ankit, to make it interesting, on a no-name basis, can you tell us those 2-3% of equity that you guys go and give back to the founders? What has it blown up in terms of a takeaway or a real life example? No need.
No, I mean, I can give many examples. I'll give an example of Swiggy. No name here, so we invested around 50 crores in Swiggy when the valuation of the company was close to $250 million. This was in 2015-16. And I think we are especially questioning that will put people buy food online. Right? And at that point of time, instead of a company has raised 50 crores of equity versus 50 crores of debt, right? See, in our case, there is a little bit of equity dilution because we take very small equity burdens in the company. So for 50 crores of equity, we take equity worth 5 crores, right? That means 45 crores of equity dilution was saved in the company. Now Swiggy is valued at $10 billion, which is almost 30x of that price when we entered. So the saving for the company, founders and investors was 45 crores multiplied by 30 times, right? Which is, you can do the math, it's almost 10,000 crores. And if a founder owns 20% of the company, and a company has saved 1,000 crores, founder has saved 200 crores of equity. When company probably gets listed or get bought. And there are many such examples. That the math is very simple, right? Whatever amount of debt you are taking, right, is the amount of equity that you have not diluted. Now, whether your company has grown 5x, 10x, 20x, that multiplied by the debt that you have taken is actually the equity that you have saved for yourself, including investors and founders.
Okay, next question for the sake of all the founders. What is your process? And has there been a case where a startup has got equity but you guys have backed out from the deal?
It's very, I'll probably answer the second question first. It's a very interesting question, right? Not all great equity, not all great deals where it could be great equity deal for me but may not be great debt deal. It could be a great debt deal for me but may not be a great equity deal. For example, let's say crypto, right? If I was an equity investor in 2020-21, I would have taken at least 10 crypto levels because it had a potential of outsized outcomes, right? Potentially companies could have become $1 billion company in a matter of a year. The way crypto industry was kind of, swelling and increasing, being an equity investor, I could not participate in that because I'm in the business of taking risk. Some bets have to have an outside outcome. It doesn't work, it's fine, but I cannot miss 100x. The biggest thing, when you talk about the largest venture capital investors, they don't judge themselves with the failures. That okay, they invest in a company tanked. They judge themselves in what is the opportunity that they have missed in an outsized outcome. Sequoia judges itself because they missed the cut, right? Not because they invested in a Zomato. That is fine, but how could you have missed the cut, right? The point I'm trying to make is that as a lender, that's what I want from me. I want to ensure that company should survive for 4 to 5 years. Because even if company goes 100x, I'm not getting 100x like a Sequoia does, right? So for me, a company which is a very binary risk, binary outcome, for example, a gaming startup, right? A gaming startup in very early stages could become 10x or could go to 0 in a matter of a year. I don't take those bets. But if it's a gaming studio which has raised some capital and because there are multiple games, there's a very high chance some of that will definitely work. It could be a good deal for me. But for equity, I am taking very high risk, high return. In most cases, equity debt both make sense. There are marginal cases where the outcomes are very binary, where there is very high risk, very high return. It's a good equity bet, but not a good debt bet. To your first question in terms of process, the process is very, very fast for us. So we don't do a 6-month, 3-month diligence like equity investors. We also don't work like a bank where we'll sit on documents for 3 months and move gradually. If we like something, we have moved from first conversation to funding in a matter of a week. Like we speak on a Monday and Friday, the cash is in bank.
Size of the deal?
That doesn't matter to be 100 crore deal. So for us, the amount of time we take to evaluate a deal and the speed at which we move is agnostic to sector size and amount. We typically take 2 to 3 weeks to study a deal, go to an IC, do our documentation and fund an amount. See, because the reason is, it's not that we are superstars and we are able to understand things very well. We don't need to waste time in something that somebody has already done. It is already a venture capital investor who has done diligence in the company. I don't need to do a diligence again. I just will rely on the numbers that I've seen. And since I'm in the market, I keep studying everything day in and day out. The moment a company comes to me, I've almost already made my mind whether I'm going to fund or not. So nothing is a big surprise for me. So if a company raises a Series A, I almost will know what is this model because I funded another 10 companies in that space. I only know the investor. I look at the business, I would have looked at that business model maybe 100 times over. Hence our speed is very fast. So, to answer your question, the process and speed is extremely lean and fast.
And I think just to add to that, that's why even if it's a competitive company or even if we're funded in the similar space, founders are more than happy to talk to us and come and start relationship with us because they know that we understand the space. And we understand the space because we put in our own money there and we have learned it through their journey, right?
I'm sure when investors have come to you to get opinions on.
No, that actually happens a lot. And the reason why Sweta was talking about, we also help a lot of our portfolio non-portfolio companies to get access to all the investor group that we partner with, is the fact that we actually end up doing many more deals than even VCs. We do like almost 90 deals a year, almost 1 to 2 deals a week, across stages, across sectors. So the amount of access we are privileged to have in terms of what is going on across the entire startup universe is quite amazing. Hence, which we are able to take that, we are able to move faster, and hence we are able to also connect to relevant investors, and they also keep talking to us for them to also understand what are we seeing in the market.
Are you okay with safe notes?
See, ours is a debt instrument, so safe note doesn't apply. So we only do debt, and debt has a specific 2 to 3 year tenure where the money comes back. Safe is more relevant for equity.
Hi, Ankit. A question from my side. You, as earlier said, that you are investing in Series A, and after that series. So, what about pre-Series A or seed stage? So, my company is in seed stage and looking forward for the fund to grow the market and onboard the employees. So, how we can collaborate and get a mentorship or any
See,
direction?
collaboration, mentorship in terms of what we do from our activate side, where essentially the point is where we are not able to provide capital, we try to provide support. In terms of capital, we feel that till the company raises at least 15-20 crores of equity capital, we feel it's too early for company to even onboard, even if we are ready. Ideally, we don't suggest founders to take a debt liability because your startup may not be at that stage to either survive through a profit or that equity capital base for you to take on some liabilities. So we think that ultimate is debt capital and the right stage for companies when you raise at least a certain amount of equity.
We have spent something around 5 years time to create innovation with the pilots. Now, the coming months, we will go to the corporate alliances. Either the corporate who has already market access, that is service side, telecom operators, or the product distribution side like Bajaj or other groups if you will. So whether instead of when we do the corporate alliances, there is a time required, maybe 6 months, 8 months, but we cannot stop our journey. We keep continue about whatever running business. So whether if you see such kind of potential, we directly access market access with the corporate. Whether your firm will be also interested to apply for it.
Yeah. So look, we do have companies with market access, but again for that, what we see is have you already achieved your product market fit? Do you already have 1 or 2 customers, paying, non-paying, irrespective? Because unless and until you don't have that proof of concept, if you don't have that product market fit achieved, if we take you to a corporate, the corporate wouldn't even talk to you, and they create a perception that this company is very early. Even if next 2 months you get your 5 contracts and your product is much more mature, they may not be willing to talk to you sooner. So the suggestion is wait till you get at least few customers, till you go to these large companies.
We enroll the corporate to get the products with using their supply chain. But there is a, there is a corporate, this is a required time for a few months to get a deal to enter with a 500 crore investment. That makes our brand as their own entity, part of their business portfolio. But there is still, when you do the component manufacture, we still require also cash to running out because we have the 30 SKU, lot of, also has a lot of servers. So whether...
What's the precise question?
So in this duration of period, whether we can use your debt capital,
No, that's why I said I think the stage that we typically come in is either you are profitable or company has raised certain amount of equity capital. Because for this stage, honestly the risk is pretty high, and the right capital to adjust that risk is equity capital, not debt capital. Because if somebody is taking a call to get to take that stage, they deserve much higher return. And that higher return essentially is equity. Which is I keep taking that whole thing back again, it's risk and return. That for certain stage, if a certain capital is going, if the risk is very high, the return should be very high, potential return, which is essentially venture capital equity. Hence our stage is typically a little bit more late stage, where some equity has been already raised, or this is at a certain scale where you can service the debt without even raising equity.
I have one question for Ankit and one for Sweta. So Ankit, we tried with a lot of D2C brand for something called as the revenue-based financing in the early stage. So we got some responses, some people will give it. But I think it's very similar to that, but could you recommend something in the seed stage, any active fund like a debt fund? Because somewhere where the revenue-based financing is not working, at least in the seed and pre-seed, are there any good debt venture fund which can also look at and then we can reach out to?
See, the unfortunate answer is mostly not. See, if it was an opportunity, we ourselves would have done it. We do series A, B, C, D and beyond. Our check sizes can range from 3 crores to 200 crores. The reason why it has not done, there are some NBFCs and funds who does it here and there. But are there proper units who does seed debt capital? It's not there because of the fact that the risk associated at that stage is very high, which lenders are not comfortable given the stage. So at that point of time, I think there aren't many units who does that. Revenue-based financing is one of the options where they essentially give you a very short-term line based on your revenue.
And for Sweta, actually, just want to understand more on this Activate thing. Is there any process? Are there any fees associated? Is it like an accelerator program or how is this program?
Sure. So we don't have a structure to it. There's no fees that you pay for the program. What we do is we individually sit with you, understand what journey what stage of the process in your journey you are. What is the kind of challenges that you are facing right now, and how can we help you solve those challenges? So we sit with the companies individually and understand, and then accordingly help them get connected to the right stakeholders. I'm happy to chat offline with you.
How to get the appointment?
We are fairly accessible. Yeah, we are fairly accessible.
Hi Ankit, what's the process of designing a term sheet for an industry company, like the ROI? Do you fund them basis the cash flow, or do you fund them because the VC is investing in it? So what's the process with which you choose a company and design your term sheet?
So we don't do too much, if I got your question right, we don't do too much of risk-based pricing. Our entry point is Series A and beyond. So commercials are pretty standard across deals. So we typically charge 14-15% interest rate. We take 10% equity warrants in every deal, which means that if I'm funding 10 crores, I will take 1 crore worth of equity warrants to give me an equity upside. My overall IRR I'm expecting in my portfolio is around 18-20%. So 18-20% is what I expect to make in my portfolio. And the way I look at deals differently is the amount could be different, structure could be different. But my commercials, like an equity deal where valuations could be very different across stages, for debt deal, there is not so much of risk express.
Okay, on the macro front, what's your view on industry with the current global turmoil? Which industry is looking good to you? Or while you are sector agnostic, I understand in terms of choosing a company, but generally, is there any industry you would like to name?
See, I think these are very seasonal frameworks that we typically use because something is hot, something is not. I think the way you should see is that look at the size of industry, right? Industry cannot be hot and cold, right? Today everybody keeps saying that pure education is not that hot anymore, right? Education is still the biggest industry with most amount of money flowing every day. Have people stopped going to schools? Have people stopped paying money for their children's education? No, right? It's just certain business models sometimes are very hot, sometimes they are not, based on the amount of capital what is there in the market. If it is a very supply heavy market with a lot of supply of capital, you will start seeing more marketplace models where They may not be revenues, but the growth is extremely fast. You'll start seeing those kind of businesses getting funded. In these markets, investors will start asking a lot more questions about revenues. They start asking questions about profit also now, right? It's just a move to the market in some what business model works in certain stages. But if you look at sectors, ultimately, especially in a country like India, just look at our population, then look at the growth that we are having, right? There's just so much to be done, so much. If you look at education, if you look at healthcare, if you look at payments, logistics, pet care, I mean, just look around us. Find what you're good at. Find a space where there's a right space and you can go and disrupt with what you're good at. Is there a big target addressable market? Is your idea can take that to a certain scale, right? And now that is education, whether it is SaaS, whether it is healthcare, it doesn't matter. I think one should not start because a sector is hot today. You start a company because sector is hot, tomorrow it will go cold. You can't do another startup that way. That's broadly what I would say.
Yeah, my last question, I also share one of the I participate in Tycoon event and one of the angel investors who come to us. So my question about whether your approach to choose the company to invest which is investor friendly or the profit friendly. So I'm sharing examples. So angel investor come to us like, okay, I want to invest, 2 CR in your company actually. So when I share about my IoT portfolio, smart camera and vehicle prevention, accident prevention camera. So he choose that, okay, I have also for the socially grounded, I have started health tech device to be innovated in the COVID prevention. So suddenly I read, okay, I want this futuristic business model, something which any other company not think about it. So that is the investor friendly, his approach to invest the money as an angel investor. So your approach about the investor friendly approach or profit friendly approach?
So honestly, we put capital to get our money back with interest and upside. So okay, jokes apart, look, that's the reason that's how I started it. Like you have to understand investors' mentality. Right? An angel investor is not investing in a company to do a social service or to create an impact on a certain sector. Right? They know for the fact that it is a very high risk capital. A lot of angel investments will go down. Something has to work. So everything has to aim for high risk. All angel investors should expect that every investment that they make should give them a 20 to 30x outcome in each every opportunity, right? And for them to make 20, 30x, right, you need to run fast, you need to scale fast, right? And that's how most angel investors, that's why venture capital investing happens. That's why you choose this, either you choose this path or you don't choose this path. If you choose this path, you need to be very agile, you need to grow fast. Or you can choose to be a company which is growing at 20%, 30%, create impact, be profitable, own 100% of the company. But when you're taking somebody else's capital, take with all ears and eyes open in terms of what is the expectation of the investor. I don't know if that answers it. One last question.
So, just to clarify, you stated that primarily you look at companies who have raised investment and then you go. But do you look at companies who are doing good in terms of revenues, are profitable, or that's something you're not sure about?
See, typically our relation is if a company is actually pretty large, has revenues, has profit, then very likely they'll probably get back. Then we are not derivative. So our target zone is to look at companies. See, Bangalore is much cheaper than us. Right? Our target zone is a zone where nobody else can fund, which is Series A plus companies which could be loss-making, which are not touched by banks. So if a company is not raised any venture capital, but has a lot of revenues, a lot of assets, a lot of profit, then we would wonder why it has nobody else. And one of the other factors for us, because we don't do third-party diligence, which is very important. That's also the reason why we look for venture capital investors. That even if the companies also, they are profitable, they have revenues, but we don't have the bandwidth to do diligence. Hence, we look at some diligence being done by an institutional investor.
So how does the return happen? Is it event-based, liability event-based, or revenues also you start taking the first?
Our repayment schedule is predefined. So whether it's coming from revenues, your current cash, your profit is predefined. Every month you pay a certain amount of interest and principal back.
Okay. And it's almost a EMI.
Yeah, it's almost like
then how is it linked to the next round? Because if the next round doesn't come, you are...
If the next round doesn't come, I may lose a good part of my capital.
Okay.
If a company has runway of 10 months...
have lost anyways by the
So if a company has runway of 10 months, I'm giving 20 months capital. So 10 months I will probably get the capital back, but next 20 months I will not get the capital back. So my call is that I need to take a call, is this business good enough to raise an equity?
Okay. So, two questions. You take a board seat?
We don't know.
Second, you mentioned that you are taking senior. So the company already has backed it, right?
So we then see, in almost all cases, we don't find an existing lender because we are typically the first lender into companies. There are cases in late stages where there could be another bank, then we take pari passu charge in those cases.
So it is senior to a convertible note too.
Yeah, that's it. See, convertible note is equity.
Yeah, sure.
Okay, folks, I think we'll end the formal part of it. They'll all be here. I think now is when you can kind of come and ask them one-on-one questions and stuff. Please don't tire them out. It's not that they've come with a checkbook and we'll give you checks on this. Relax. So thank you again. This is wonderful, and this is really eye-opening for a lot of folks. Thanks again.
So thank you guys. Thank you so much, and I think I judge the fact that the audience is either listening to me or now sleeping by the fact that the kind of question that they ask. So I'm assuming all of us heard us very clearly because the questions were extremely relevant and very pertinent. So hope you guys learned a bit from the session.
Absolutely. And folks, there is some pizzas and French fries, and of course, you have a choice of a beer or a tea coffee. I'm not sure of that, but my team will tell you. But please, kind of, make use of that. Last time everybody left, and there was a lot of excuse. Please don't waste food. Thanks again. Thank you.
Thanks.